Now, I'm going to start this morning talk a little bit about politics and the markets. And some of you may have heard, we have an election coming up just around the corner. And I think probably one of the questions we get more than any other for clients is, what effect is this election going to have on the markets? And then by sort of fallout from that on their portfolio specifically. So what we're going to do this morning is take a look at elections and politics and then market performance. Now, Jim spent a little bit of time talking about where we are today, so I'll go through that relatively quickly. We'll spend some time talking about the presidential election cycle. We'll examine politics' effect on past market performance. And then lastly, we'll take a little bit of an inside look at the two candidates' portfolios and see if we can learn anything by how they invest their money. So let's start with the first question. Does this even matter? Well, as we recently saw in the UK, and as David Hernandez will go into far more depth in his flash talks, politics and elections can clearly have an effect on the markets. Now, this chart shows you the British pound against the US dollar. And as you can see, the UK's decision to exit the EU, aka Brexit, came as a shock to the market and led to a sharp sell-off in the pound. So clearly, politics and elections can have repercussions in markets. So now let's look at the candidates. Looking a little closer to home at the US election, there's been a lot of talk about just how unusual and how unpredictable this election cycle has been. And one thing that's particularly unusual is that according to Gallup, this is the first time in history that both candidates have an unfavorability rating with the general electorate heading into the election. Now, that may be one of the reasons why the Chicago Tribune this morning came out and endorsed Gary Johnson, the Libertarian candidate for president. So this is certainly an unusual political climate. So now that we all know who's running, we want to know who's actually going to win. So we'll start with a little bit of the Marquette view. Every year in January, one of our consultants, Mike Spahalski, asks all of us around the firm to predict where we think the S&P will finish the year, what the 10-year Treasury will be, inflation, and of course, this being election year, who we think is going to win the presidential election. Now, to spare myself and all of my colleagues some embarrassment, we're not going to give you our market predictions, but we do have for you here is our straw poll of who we thought would win the presidential election back in January. Now, mind you, this is who we thought we would win, not who we were going to be voting for. Not too surprisingly, most of us thought Hillary was a good horse to back. But what's interesting is a significant number of Marquetters were on to the idea that Trump actually had a fairly legitimate shot at the White House long before most political experts did. So what are the polls saying today? Well, as Jim showed you this exact same chart on the next slide, so you can see both of us have access to a Bloomberg machine. This is the real Carol politics, and as Jim mentioned, there's a pretty tight race, but pretty consistently you see Hillary leading in the polls. Now, if you roll that forward and you look at the prediction markets, Jim showed you the predicted prediction markets. What we're showing you here is the Iowa electronic markets. This is the same thing. These are markets where you can actually bet real money on the outcome of who you think will win the election. And again, I might disagree with him a little bit. People talk about this being very, very close. But if you look at the prediction markets, you see about a 70% chance that Hillary will win. So I would say that's probably not quite as close as some political pundits would say. Now, turning to the markets on the next slide, we would tell you that that is basically what we think is priced in today. And despite all the twists and turns in this election cycle, the importance that so many political pundits have put on this election, the markets actually don't really seem all that concerned. We did have a little volatility earlier in the year, but what you can see here is the market's on pace to put in a very thoroughly average year. As of yesterday's close, the markets were up a little bit less than 7%, pretty consistent with our expectations and long-term averages. So the question is, why don't the markets seem all that concerned when the political pundits are very focused on this election? And I think there's maybe some insight we'll show you on the next slide. So if you look at voters' major concerns heading into this election, according to Gallup, and we strip out dissatisfaction with government and the economy in general, which are sort of the I wish I were better looking and I wish I were smarter versions of voters' complaints, you can see that only one of the issues is economic related, and that's unemployment. So in this election cycle, maybe it makes a little sense that markets don't seem to care much about what's going on in the political arena because it doesn't seem to be driving voters' decisions. So if markets don't seem to be paying much attention currently, one of the things we'll ask is, can history be any guide? So interestingly, there is a theory out there that says you can predict the markets based on the presidential election cycle. Now, this was first popularized by Yale Hirsch back in 1967. He's the author of the Stock Trader's Almanac. And what's interesting is it's turned out to be fairly prescient for a number of years afterwards. But what you can see is we have actually seen some notable exceptions more recently. So what is the presidential election cycle? The logic here is actually pretty simple. The thinking goes that markets often struggle during the first year of a president's term, and that's really due to the fact that the president will oftentimes force through tough, unpopular legislation when they have a strong mandate from voters. And then this leads to poor economic and market performance in the short term. But eventually, as the president approaches the next election, he or she pursues more stimulative and popular policy, and this helps boost the market. So let's look at the data. And actually, you can see that there is some truth to this. What we're showing you here is the average annual return since 1948, i.e. the post-World War II era. And you can see that the first year has indeed been a tough one. So to be clear what we're talking about here, the first year is the first calendar year of a president's term. So 2017 will be year one for President-elect Trump or President-elect Clinton. Now, not only has this had the lowest average annual return, as you can see, but you can see that the market's are up only a little more than half the time in the first year of the president's term. However, you can also see that there have been some really important and notable exceptions, particularly recently. The first 2 years of Obama's two terms, 2009 and 2013, you'll all remember were excellent years at the market. So we caution anyone before they make too many important portfolio decisions based on this data. The next slide, we'll take a look at Congress, and this is something that Jim covered as well. Right now, our expectations are that the Republicans will hold on to the House and that the Democrats are likely to take the Senate. Now, on the next slide, we'll tell you why we think that's so important. Today, more than ever, politicians have become increasingly polarized. Now, this is something we all know in general, but we think this is some interesting data compiled by two professors at the University of Georgia who examined roll call votes in Congress since 1900. And as you can see, it has become increasingly difficult to get politicians to cross party lines. So it matters greatly to the president-elect who controls Congress, since it will be very difficult to work with the opposition to get anything done. Now, in addition to partisanship, that's really being driven by polarization. Now, using that same data set on the next slide, what we'll show you is that two parties are ideologically farther apart than they have ever been, with Democrats becoming modestly more liberal and Republicans becoming increasingly more conservative since 1980. This is clearly not an environment to get things done. So what does this mean for the markets? Well, history provides a relatively small sample set here. It's almost certain that the Republicans will hold on to the House. And since the Democrats actually have controlled the House from 1949 to 1995, so 45 years during the early days of the post-war era. And so that means the sample set with Republicans in control is actually relatively small. But that being said, historically, divided government's actually been pretty good for the markets, with the one notable exception we show you on the far right-hand side of the early Bush years when the tech bubble was busy deflating. Now, this next chart will hopefully be the most boring chart you see all day today, but that's sort of the point. Only once in the post-Bretton Woods era, i.e. post-1972, has the Fed hiked rates in the two meetings prior to the election. So that was even true in 1994 and in 2004 when the Fed was in the middle of a tightening cycle. So as a result, we did not expect that the Fed was going to raise rates back on September 21st, and we do not expect them to raise rates in the October meeting, which is the last meeting before the November 8th election. Now, we know all of you have a little bit more than just US equities in your portfolio, so we thought we'd take the same analysis and look at the bond market. And interestingly, you can see that the first year of the president's term has actually been somewhat challenging for bond markets as well. So if history is any guide, 2017 could be a little bit of a rocky year for all of us in our portfolios. Now, last but not least, we're going to take a look under the hood and look at where the candidates are actually putting their own money in their personal portfolios. So we'll start with the Donald. Now, this data is from the Federal Election Commission, which requires all candidates running for political office to disclose their assets to avoid conflicts of interest. And as Donald Trump is very, very quick to tell you, he's got gobs and gobs of money, but most of it is tied up in real estate and golf courses. So that is excluded from this analysis. What we're showing you here has a total portfolio value of about $150 million. And this represents the majority of the Donald's liquid net worth. Now, it's kind of an interesting portfolio. There's no bonds whatsoever here, lots of US equities, and a pretty big bet on hedge funds. And we ran this portfolio through our asset allocation software, and you can see we expect it to do a little bit better than 7% annually. And in this market environment, that's actually a pretty good rate of return. But you can also see he's paying a lot to do this. Portfolio management fees are close to 100 basis points, and he's got performance fees on roughly a third of the portfolio. And so far this year, at least, the results have been somewhat disappointing. You can see our estimate is this portfolio is down a little bit more than 1% through the end of June. Now, peeling back the onion a little bit and looking at the underlying managers, you can see there's a lot going on here, a little bit like with Donald Trump himself. Looking specifically at the US equity portfolio, you can see he's got a large separately account mandate and then 6 individual mutual funds. Now, I'm sure he would tell all of us these are tremendous managers, the best out there, and this is a beautiful, beautiful US equity portfolio. But when we drill down and do our analysis on a holdings basis, the kind of things we do for all of you, you can see that all of these managers are doing exactly the same thing. So we would tell him this is probably not a fabulous portfolio, but a little bit more of overkill. Now, last but not least, we'll switch gears and look at Hillary. Now, Democrats have not always been known for being cost efficient, but Hillary Clinton has about as efficient and low cost a portfolio as you can possibly get. This portfolio has a total value of about $25 million, and you can see it's about 25% in cash, and the rest of it is invested in a single fund, the Vanguard S&P 500 Index Fund, which costs just 5 basis points. Now, you can see from an asset allocation perspective, our return estimate is a little bit lower here. We're thinking about a 5.5% annualized return for this portfolio, and that's largely driven by a large cash allocation, which is earning 0, and a lack of diversification. But what's interesting is you can look at the numbers and see she's actually doing pretty well so far this year. Her portfolio is up a little less than 3% through the end of June, outperforming the guy who's supposed to be the great investor. Now, the last thing I want to touch on today is before I let you go, we are lucky as Americans to have the opportunity to vote and choose the leaders that run our country. So no matter who you're going to support on November 8th, we encourage you all to fulfill your civic duties and get to the polls. And as we like to say in Chicago, make sure you vote early, and vote often. Thank you very much. Next, I'll call up my colleague Ben Moore to talk about fixed income.